Hello and welcome to BullionStar. I'm Claudia Merkert and today I'm joined by Ronald-Peter Stöferle. Ronnie is one of the most respected and insightful voices in the precious metal space. He's the managing partner at Incrementum, an independent fund management company, and the co-author of the In Gold We Trust report, a publication that over nearly 2 decades has become a must-read for investors, analysts, and gold watchers around the world. Ronnie, thank you for joining us at BullionStar.
Thank you very much for having me, Claudia. It's a pleasure.
Well, the 19th edition of the In Gold We Trust report was released just last week on the 15th of May, and I'm feeling very privileged to have you here so that we can dive into your latest insights on precious metals and the global macro scene. I noticed the picture that you shared online of your team enjoying a big celebration dinner after the report's released last week. It must feel like a huge accomplishment to put together a 450-page report in 4 languages.
It is, yeah. My wife doesn't really like the analogy of, being pregnant and then giving birth, but it's like so many months of work. The whole team has worked approximately 25,000 hours on this report. We publish not only in English and in German, but also for the first time in Japanese, in Spanish. And we really want to publish the best piece on gold, and therefore it has to be well written, well researched. We want to prepare like the best charts. It should also be to some degree funny, so we use side comments and quotes, some cartoons. It's lots of work. We enjoy it, but I'm very, very happy when I'm hitting the send button. And not only the team and I, we're happy, it's actually, everybody around us, because it's very, very demanding, but it's worth the effort.
Yeah, I love all the side notes and the jokes. They're very amusing, so I very much enjoy that and appreciate that. So this year, the report's title is The Big Long. Can you please share with our audience what that title means exactly?
Well, obviously, it's a reference to The Big Short, a movie that I always enjoyed watching, and I watched it a couple of times again for this year's report just to prepare. And the analogy is a little bit like, if we circle back to The Big Short, where Michael Burry and some other contrarian investors realized very early on that something's not really right. And they were kind of ridiculed. They weren't taken serious by Wall Street, by mainstream investors. And at some point, even Wall Street realized, okay, this whole subprime thing could become like a systemic crisis. So from our point of view, we're in a systemic crisis of our monetary system. And we're not like in 2005 with The Big Short. I would say it's more like 2007, where more and more investors finally wake up and realize, okay, something is going on behind the curtain. So we are now really seeing, Claudia, that more and more institutional players approach us asking about gold, asking us, is it already too late? Is it too expensive? Why is gold rising without making any bigger pullbacks? And therefore, I think that we are now in this stage where gold is really becoming to some degree more mainstream in the Western world. That's important because I think this bull market is mainly driven by emerging market demand. And our thesis is that we're not the end of this bull market. We're somewhere like beginning of the second half. Gold is not a contrarian investment anymore, but we haven't seen this mania phase yet. And from an investor's point of view, because we are primarily asset managers running investment funds, our take is that gold always goes first, and then with a slight delay, silver, mining stocks and commodities follow. And therefore, we suggest an overweighting of what we call performance gold, primarily silver, mining stocks and commodities. So it is basically a strategic call to stay invested in gold and hard assets. From my point of view, I would say this public participation phase that we are currently in, this is really something that many people that don't know too much about gold kind of mix up with gold being in a bubble. We're now seeing basically that gold starts becoming more interesting for Wall Street banks again. We're seeing that the large banks are kind of raising their price forecasts. We're seeing that more and more interest is coming from the media, that there's more products being launched. So this is this typical public participation phase, the second phase based on the Dow theory. And of course, this bull market will end in a mania phase like it did in the 1970s, where the price of gold almost doubled within 8 weeks, or a bit similar like in 2011, where we made this parabolic move to 1900 within a couple of weeks only. But we're not there yet. So therefore, I think the risk-reward ratio for gold is still an excellent one.
Well, your report, it makes a strong case that we're in a new secular bull market for gold. And what would be the forces that you say are driving that bull market?
Well, it's driven by emerging market demand. And this was the leitmotif of last year's In Gold We Trust report, called the New Gold Playbook, where we said, folks, let's face it, the center of the gold market isn't in London or New York anymore. It's in Shanghai, it's in Mumbai, it's in Dubai. I would say that the physical demand from central banks in emerging markets, but also from private investors in emerging markets, is like the foundation, the basis of this bull market. For central bank buying, we've seen 3 consecutive years with purchases of more than 1,000 tons of gold. So last year, we've seen an all-time high in terms of the size, but also the amount. So it was more than 100 billion being invested by central banks in gold. But we're also seeing that despite the fact that the price of gold has risen quite a lot last year, we're seeing that physical demand from Asia is still not really affected by those high price levels. So people are kind of getting used to higher price levels. I would say the second trigger for this bull market is obviously the loss of trust that we've seen over the last couple of weeks. I think Donald Trump did a great job in destroying the trust foundation or the trust capital that we've built over the last couple of decades. And I think one of the best examples for that is the fact that during Liberation Day, which was, it's quite a volatile couple of days, what you usually see when markets are in turmoil is the US dollar trending higher, and then, the classic safe haven US treasuries being bought. But this time around, we've seen exactly the opposite. So the dollar was selling down and yields were rising, which is kind of a sign that there's a paradigm shift going on and people don't really trust this safe haven in the US anymore. And then I would say like the third pillar of this bull market is obviously de-dollarization, which goes hand in hand with the central bank buying that I mentioned before. But it's pretty obvious that we need a neutral monetary reserve asset. And that's basically an interesting thing, is that the Trump administration is very vocal when it comes to addressing the so-called Triffin dilemma, when it comes to addressing the structural trade deficits that the US has. So therefore, I would say that some sort of a Mar-a-Lago Accord will happen at some point. And Scott Bessent, he said that he wants to be a part of that. And I think it's interesting that Scott Bessent said that they used to call him a gold bug when he was still working for George Soros, and that gold is still by far his largest private holding. So therefore, I think that, gold is at the moment becoming more center stage, and, things like auditing Fort Knox or, for example, a revaluation of US gold reserves. This was kind of a topic that was discussed only like in the gold scene, but now it's really becoming mainstream. And I think that's a sign of this, what I would call a silent remonetization of gold.
And so we had these sort of cycles, bull markets for gold in the 1970s and the early 2000s. How would you say that this one is different to those ones?
Well, I would say it's broader and it's perhaps a little bit more systemic. In the 1970s, obviously, end of the Bretton Woods Agreement. For the first time, basically, the US dollar wasn't backed with gold anymore. We've seen the inflation spike. Actually, it was 2 big inflation waves. We've seen political crises, but I would say the demand was much more driven by Western markets. Now, as I've said at the beginning, 2/3 basically of physical demand is coming from emerging markets. And I would say for this next stage of the bull market, Western financial investors will be one of the main drivers. We've shown one pie chart based on UBS data, which says that family offices, which are very important long-term investors, at the moment they hold 1% in precious metals. Not gold, but precious metals altogether, just 1%. And from my point of view, this massive underweighting or underinvestment by Western financial investors, that could be really the driver going forward. So I think the main difference that this bull market for the time being is driven by emerging markets and not Western investors.
Interesting. Okay. And then earlier you mentioned that there's 3 phases to the bull market and that we are, is it correct, in the second phase, the participation phase? How long do you expect that phase to go on for? Whereabouts are we in that phase?
Well, this kind of model is based on the so-called Dow theory. So Charles Dow is kind of the godfather of technical analysis. And I did the CMT program, which is the Chartered Market Technician. And that was like one of the foundation of technical analysis, where Charles Dow said every big secular trend has 3 different phases. So the first phase is the accumulation phase, where only contrarian investors that really have, the guts to buy something that everybody hates start buying. This is like the moment, if you imagine you're going to a cocktail party and you're saying, I'm buying gold, people will ridicule you. They will say, Claudia, you're crazy. I mean, gold is just falling. It's useless. Nobody wants to have any gold. So this is the first phase, the accumulation phase. And then the second phase starts, which is the so-called public participation phase. That's the longest phase. And this is the phase when the price is going up, when, the media picks up the topic again, writes in a more positive way, when new products are launched, when, for example, the big banks start covering this asset again, when they raise their price forecast. And I think we're now absolutely there. So, for example, based on the Bloomberg CPF, so commodity price forecasts, we had like last year when we published a report when the price of gold was trading at $2,300, every Wall Street bank was bearish on gold. They expected gold to trade lower, down to 1,800 or whatever. Now, all the Wall Street banks basically say, well, we're going sideways at current levels, so 3,300, 3,400 this year, next year, and then it's going to fall. Usually at the end of every trend, you would see that, analysts come out with, more and more bullish forecasts. So it would be like Goldman Sachs says gold is going to 8,000 within the next 2 years. So this phase, the public participation phase, is the longest phase, where you see only very shallow drawdowns. This is the phase when you go to the cocktail party again, say, well, I'm buying gold. People will say, yeah, Claudia, that's a good move. I also bought some gold recently. So everybody kind of, gets accustomed to this idea. And then the third stage, that's obviously the distribution phase, when those contrarian investors start selling again. This is the mania phase where, as I've said, Goldman Sachs, gold will go to 8,000, whatever. If you go to the cocktail party and you say, well, I'm buying gold, people will say, no, Claudia, you have to buy silver and you have to take 10 times leverage. You have to buy this junior mining stocks with a market cap of 5 million only. Yeah, this is like a 10-bagger. So I think we're like somewhere in the middle of this public participation phase. We will, like in every big secular trend, there will be a mania phase. This will be the time to become cautious. But again, I think we're now at this stage where silver, mining stocks, and also to some degree commodities will really start outperforming gold, because so far they have underperformed gold. We did the math on that. We did the analysis. In every big secular bull market for gold, silver, mining stocks, and commodities usually outperform.
Interesting. So would you say this is the most mainstream gold has felt in years, or is it still early?
Yes, I would say so. Yeah, it is becoming more mainstream. And I can tell you from, the reception that we get from the report, there's now people that are kind of outside of this gold industry, gold bubble, gold camp, or however you want to call it, starting to get interested, say, well, you wrote 450 pages. So why gold now? But I'm still seeing quite a lot of skepticism, because many people still say, should I sell gold now? Which is a good sign that, the market is still climbing this wall of worry and that we're not overly confident. And this is also confirmed by some sentiment indicators. This is confirmed by the Commitment of Traders report. Let's not forget, gold was trading at 2,600 at the beginning of the year. And then we went up to 3,500 within only a couple of weeks. And sentiment indicators have cooled off dramatically. So usually if there's like this mania phase, sentiment would have to stay elevated, even though, prices aren't confirming the move anymore. So that makes me pretty confident. However, I would say that for the next couple of weeks, we probably won't miss too much. I would expect some more of a sideways consolidation. Perhaps we'll trade lower. So I think we have to digest this move, but I think the downside is pretty limited.
Okay. Well, gold's been surprising me today because I thought exactly the same, and it's up 1.5%. Up over 3,300. So nothing wants to keep it down at the moment. Speaking of your confidence in your vision, in 2020, your report was titled The Dawning of a Golden Decade. And in that, you forecast the base case price of $4,800 for gold by 2030. Now we're halfway through the decade and gold's already touched 3,500. So do you feel even more confident in that long-term vision based on what gold has done this year?
Yeah, well, I think our model works pretty well so far. And I worked in a bank for quite a long time. And I know that the more complex and the more sophisticated a model becomes, the less it works in real time quite often. So our model is a very simplistic monetary model for gold. And we said it back in 2020, 4,800 by the end of this decade. This is our forecast. And back then people were ridiculing us, saying, what are those guys smoking, or what are they actually doing? So now it is becoming more and more accepted, which is also confirmation that we're like in this public participation phase. So we are now somewhere in the middle between our base case scenario and our inflationary scenario. Now, it seems that everybody believes that we're going back to the old regime, which is like the Great Moderation. People believe that inflation is dead, that, we go back to below 2% again. I cannot rule out that we'll see another inflation wave. And if this is going to materialize over the next couple of years, then even our inflation case could become reality. And that would lead us to roughly $8,900 by the end of this decade. Now, that sounds still pretty optimistic, but if we compare it to previous bull markets, that's totally realistic. And also, if we compare it to monetary aggregates, you have to say, compared to M2 growth, gold is still extremely undervalued. And my take would be that at some point over the next couple of years, there will be some sort of a official remonetization of gold. And the fact that the US imported more than 2,000 tons of gold over the last couple of weeks, that might be one confirmation. If you listen to Scott Besson, if you listen to Stephen Mirren, if you read the papers by Michael McNair, for example, it really seems that something is happening behind the curtains. And that also goes hand in hand with this trend of repatriation of gold. And the fact that, you said gold is pretty stubborn up there. It just really doesn't want to correct any deeper. That would also be some sort of a confirmation. So 4,800 by the end of this decade is our base case. 8,900, that would be the inflationary case.
Okay, well, that all makes complete sense to me. But what do you say to people who say gold's too expensive to buy right now? Because it just touched its all-time high a few weeks ago in April of 3,500. What would you say to people who are hesitating to still buy at this point?
I would say that, gold isn't dirt cheap anymore. That's clear, but it's not extremely overvalued. Value is always subjective. So there's obviously no fair value for gold. But what we do is we are coming up with long-term ratios. So from a monetary point of view, gold is still at an attractive price level. If we compare it, for example, the market cap of gold to the market cap of US equities, we're now at 40%. So the total market cap of gold compared to the total market cap of US equities, that's just 40%. The long-term average is 37.1. So we're slightly above the long-term average. And for example, in 1980, we were trading at 160%. So gold was valued 1.6 times more than US equities. If we compare it, for example, to other commodities like silver, gold is overvalued or silver is undervalued. If we compare it to oil, for example, gold is very expensive. If we compare it, for example, to the bond market, I would say that gold is still trading at very attractive levels. So, if we combine all those data sets that we use, I would say, again, it's not super undervalued anymore, but we're far away from those mania levels that we usually see at the end of every big secular bull market.
Okay. And so for someone who does own gold already, would you suggest in this environment that they should be holding, adding more, or rebalancing? their portfolio?
I would say, it's always the question, what is your motivation? Why did you buy gold? And last year we came up with two different motivations. The first bucket basically is what we call safe haven gold. This is something that where you don't follow the price too much. Best case is that you inherit it to your kids or to your grandchildren. It's like a monetary insurance policy. And you're based in Sydney. We talked before this interview and you said your husband is from Germany actually. I'm from Austria. And, we had the hyperinflation in Germany, first in Austria and then in Germany. If you read Stefan Zweig, The World of Yesterday, for example, which is the best book by far about those times and what inflation actually does to society, I think that in our monetary DNA, inflation is still something that we kind of learned from our grandparents. So, for example, for every big occasion, I got like small gold coins from my grandparents. So I think this gold history, this gold mentality obviously has to do with the monetary history of every country. While in the US, for example, people are more scared of deflation because of the Great Depression and so on. And there's no real culture of physical gold in the US. So my take is that for this safe haven gold, there's always a case, and we say roughly 15% of your liquid assets should be held in physical gold, where you really have to think about counterparty risk, where to store it. Perhaps outside of the banking industry, we're having lots of inquiries regarding international diversification of gold holdings. So this is the safe haven gold bucket. And then the second part is performance gold. There are people saying, well, actually, I think gold is attractive. Gold has momentum. Gold is undervalued. I want to make performance. That's totally fine. You can buy ETFs, you can buy certificates, you can buy futures, options, you can buy kind of derivatives on gold, like mining stocks, like silver and so on. But I think it's important to really make this distinction, because if you're thinking that we'll see like a monetary crisis, then obviously you should be very cautious when it comes to counterparty risks. Then obviously silver will probably underperform, or mining stocks like in 2008 with a drawdown of roughly 70%. So it is always, you have to ask yourself first, what is the motivation? Why do I want to have gold? Is it a monetary insurance, or do I want to make performance?
So if someone's waiting for a dip, do you think that's the right strategy in a long-term bull market? Or should they just be buying regardless?
I think some sort of a dollar cost averaging always makes sense. So just saving in gold. This is, for example, what I'm doing as well. Just every month I'm buying for myself and for my kids, because, you can be the best trader. You probably won't pick the best date for buying and also for selling. So I think that totally makes sense on a regular basis. And it's important always to distinguish. I think it's, from my point of view, the primary job of gold is not making you rich. The job of gold is actually protecting your hard-earned money, protecting your purchasing power over long time frames. And I think gold has done this job pretty well. And gold was up roughly 30% in 2024. Or if we take a different view, if we basically, change the perspective, you could also say that fiat currencies devalued by roughly 1/3 against gold, which is quite dramatic. So people keep telling me, well, everything is so expensive. If you go to a restaurant, if you're traveling, if you're buying this or that. And I say, well, actually, perhaps it's just a monetary problem that we're having. You need more units of Aussie dollars, of euros, of whatever, to buy 1 unit of beer or a steak or whatever. But measured in gold, your purchasing power is actually pretty stable. And this is what we try to show our readers also with, our gold beer ratio at the Munich Oktoberfest, with the gold iPhone ratio, for example. I'm obviously a big skier, so we did the same with ski tickets in the Austrian Alps. And, the message is crystal clear. Gold protects and even increases your purchasing power over long time frames. And I think that's the most important message.
Yeah, and that's why I found the visual that you had in your report, and we will put it up on the screen, about the international family offices only holding 1% in gold and precious metals. It was just extraordinary that it's so little. Do you think that the participation in this bull market will look different with perhaps more of that institutional investment than previously?
Well, I hope so. I mean, we're doing our best educating investors, and I think it's really the numbers speak for themselves. The kind of our mission that we have is presenting kind of a sober case for gold, a positive case for gold, not the gloom and doom, everything will go to hell buy gold case. I think that this emerging market demand, for example, one of the reasons for this bull market is heavily underreported. Everybody still thinks that, buy gold because of inflation, buy gold because of geopolitical crisis and so on. But very few people know actually that there's so much structural demand now coming from emerging markets. And our mission is to educate and inform our readers, very much numbers driven, data driven, and make positive case for gold from a portfolio point of view. And I think, or I hope, that this will resonate with institutional investors. But I can tell you, Claudia, that gold unfortunately has a very, very poor reputation in the, let's say, mainstream investment world. Yeah, we'll try to improve that a bit.
And why do you think that investors should view gold and silver differently from traditional assets like stocks or real estate or bonds, which they're all heavily invested in?
Well, I think that, first of all, I think stocks are not the enemy of gold, if you want to put it that way. So from my point of view, there's a strong case for equities. Of course, within equities, this rotation out of the United States and into emerging markets, into Europe, this will continue. But I think, owning parts of business, of productive assets, there's always a case for that. Where I'm somewhat more critical is when it comes to sovereign debt, to government bonds, where I would say, this is the real bubble. And obviously, that's a much bigger market than global equity market. So I think, with this correlation between bonds and equities that we had over the last couple of decades, where basically, every time we saw turmoil in equity markets, bonds were actually bid and they kind of recovered the losses that investors had on the equity side. Now with this positive correlation, there's a very strong case from a portfolio management point of view for gold, which is negatively correlated. My take would be that gold is a very, very good substitute for the bond allocation. And, with debt levels around the globe at those levels, and we're seeing with Doge in the United States that it's just not so easy to significantly reduce deficits. But then also with inflation volatility at very, very elevated levels and perhaps a second wave of inflation coming up, that's just not the best outlook for bonds going forward. So therefore, I would say gold is an excellent bond diversifier.
Okay. I'd like to move on now to talking about physical metal and versus paper. A big part of your report, goes into the discussion about physical metals. And since earlier this year, we've seen vast amounts of physical metal moving from London to New York. In May alone, there was a 718% year-on-year increase in demand for 100-ounce bars, which is larger than any monthly increase this decade. So what is driving all of this movement of physical metals behind the scenes?
I would say it's on the surface, people said it's because people kind of feared that there will be tariffs on gold and on silver. I don't really see that because historically the US never really had any tariffs on physical gold or physical silver. The amount was absolutely staggering. It was more than 2,000 tons of gold that were imported in the United States. From my point of view, and this is also from conversations that I had with important market participants in the United States, it was primarily high net worth individuals, family offices, hedge funds buying physical gold. And I think that there's more of an understanding now that actually if you really think that we're entering a scenario where there's some sort of a remonetization or revaluation of gold, you actually want to have the physical metal and not a paper contract. So it's a sign of rising systemic distrust that we're seeing. People don't want paper promises, they want possession. This loss of trust that we're seeing, obviously one big catalyst was 2022 with the sanctions against Russia. We already wrote in 2016, 2017, the age of eroding trust. And this is what we're clearly seeing, not only in financial markets, but also in the media. We're seeing it in politics, we're seeing it in society. And the less trust you have, the more you obviously want, or the less counterparty risk you want to have. Yeah, the stronger the case for physical gold in your possession. And I think therefore I would say this trend of physical possession is clearly a sign, kind of a mirror of this trust erosion that we're seeing.
So how important would you say it is to hold physical gold right now versus paper?
Very important. But again, coming back to what we discussed previously, it's really depends on your motivation. If you think we'll enter a new monetary regime over the next couple of years, and this sounds like, big conspiracy or a very sensational forecast. But if you study monetary history, it happens every couple of decades. Then obviously you want to own physical gold. If you say, well, it's going to be a rocky road, it's going to be volatile, but everything's kind of fine, then you still can go for paper contracts, for performance gold. But actually, price-wise, actually owning physical metal, it's not more expensive. And I realized that if you own the physical metal, you're as likely selling gold, for example, in a correction compared to if you own like the ETF and you've got it on your online brokerage account and you just have to do like 2 or 3 clicks, then you hit the panic button more likely. But if you own it physically, then you always are, more interested in the longer time frame.
Yeah, absolutely. And we've seen central banks buying gold consistently since 2009. And since 2022, they've added over 1,000 tons per year. Why are they doing that?
Well, first of all, I think it's driven by emerging markets. Although last year Poland was the largest physical buyer, and it was pretty interesting. Was the head of the Polish National Bank? He said it is some sort of a trust anchor. It is something that isn't affected if there is like a blackout, for example. So he was obviously also referring to Bitcoin. And we've had like a major 2-day blackout in Spain and in Portugal quite recently. But besides that, it's primarily driven by the People's Bank of China. India is buying, Turkey is buying. And compared to Western countries, emerging markets still hold a significantly lower percentage of gold. So I think it's kind of a sign that, they want to be respected. It's a sign of monetary confidence or economic confidence. And I think if you want to play, high stakes poker with the big guys, you have to bring chips to the table, and those chips are golden chips. And therefore, I think this will continue to be kind of a secular driver. If you, for example, read the central bank surveys that the World Gold Council does, where they question like all the central banks, most of them say, well, we've got like long-term strategic plans being implemented, so they're not very price sensitive. And therefore, I would think that, I don't know if it's going to continue to be above 1,000 tons, but I think it's still going to be some sort of a structural driver. And if we compare those numbers to annual mine production, central banks are actually soaking up roughly 1/3 of annual gold production, which is pretty significant.
Well, you mentioned China, and they are officially reporting that they have only, 2,000 just above 2,000 tons, but there's speculation, of course, that it could be closer to 5,000. If China did confirm that, what kind of impact could it have both on global financial stability and, from a geopolitical standpoint, if they did confirm that?
That's a great question, Claudia. I think it could happen. It would be some sort of a big surprise. And most of the numbers or most of the data that we gather and talking to contacts on the mainland, everybody kind of knows that China owns significantly more gold than the 2,200 tons that they officially hold. So I would say it's probably 5,000 tons, probably even more. And, China is the largest producer, the largest consumer, and the largest importer of gold for a couple of years now. So I think it would be naive to think that they only hold like 2,000 tons. I don't think that gold-backed renminbi is really something that they want to come up with, because every politician hates a gold standard, because it limits obviously your lending power as a politician. And I don't think that they want to come up with gold-backed renminbi, but I think it's a little bit similar to when the euro was introduced as a new common currency. The ECB was advertising that in the euro system we own more than 10,000 tons of gold, which was kind of the foundation of trust in the new currency. And if you study monetary history, gold has always been like the starting point to create trust in a new currency, in a new money, basically. So with the internationalization of the renminbi, I would say that gold plays a very important role. Does it play the only role? I don't think so. But it's already what we're seeing with all those bilateral agreements between China and other emerging market countries, with what's going on in the BRICS, for example. You can tell that gold plays a very, very important role.
Well, I mean, it's been showing that this year in terms of all of the geopolitical tension and trade disputes and currency volatility and the talk of de-dollarization. And it's been interesting to watch gold being viewed as a strategic asset again. So could you imagine that China is waiting for a particular moment to reveal their big surprise? And what would be the strategy behind that moment that they might reveal that?
Whoa, great question again. Obviously it's a very political thing. We all know that Chinese politicians don't have to deal with elections too often. So obviously they can pursue a much more long-term plan than most other politicians. We have seen with Donald Trump that he actually, with the turmoil after Liberation Day, not in equity markets, but primarily in the bond market, he had to back down. I think the volatility and the turmoil that we've seen in US bond markets really caused this U-turn by Donald Trump. Now, what's going on behind the scenes? I don't really know, but what I just can say is that during Trump's first term, the first big trip abroad, he went to Saudi Arabia. And this time around again, he's going to Saudi Arabia. Saudi Arabia was invited to join the BRICS. They haven't accepted that invitation yet. Donald Trump knows how important Saudi Arabia is for the whole region, how their self-confidence has risen. I attended the FMF, the Future Minerals Conference in Riyadh in January, and it was the most impressive mining conference that I ever attended. And I think they only do it for 4 or 5 years, and there were more than 20,000 people. So it seems that Trump kind of recognizes the importance of not only gold, but commodities in general. I think he recognizes how dependent the world is on China when it comes to strategic metals, when it comes to rare earth. He also knows that China is less dependent on the United States compared to his first term, where I think 17 or 18% of all exports went to the United States. Now we're at 13% only. So, it's fascinating, but I don't know actually if China will come out and say, well, we actually own 5,000 tons of gold and we're going to revalue it. Perhaps it's not going to be one moment. Perhaps it's going to be a process, and we're right in the middle of this process. And this would kind of explain why gold is so stubborn up there, and it just doesn't want to correct any further. But that's actually, the fascination when it comes to gold, that there's so many different drivers and so many things to follow and analyze and think about. It's going to be interesting over the next couple of years, definitely.
Well, I mean, if China is holding that much gold, that would make them the second largest central bank holder of gold after the United States. And then we have the BRICS nations, the other BRICS nations stacking. I mean, what does it mean for the US dollar and the global monetary system with the moves that they're playing? It's kind of like chess. What are they setting themselves up for? And what's going to happen to the US dollar?
It was pretty interesting that, as I've said before, Scott Bessent, he was very vocal when it comes to a Mar-a-Lago Accord. Stephen Mirren, he published this kind of playbook for this new monetary regime. And I've analyzed it on the most important takeaways on Twitter. And I've read this paper, I think, 3 or 4 times. And if we listen to what Trump, Bessent, J.D. Vance, Stephen Mirren, and most of the other guys in his administration say, I would say that they know about the structural problems. Basically, what's the term in English? They want to have the cake and what is it?
They want to have
eat
the
it
cake
too,
and
yeah.
eat it too, yeah.
Exactly. So they want and they need a weaker US dollar, but they want to protect the status of the US dollar as the world reserve currency. So that's like we say in the report, it's like squaring the cycle. It's like trying to get a warm ice pops. Yeah, it just it's
Between
not,
a rock and a hard place, we'd say.
exactly. Yeah, it's not going to happen. But I think, if we compare it to the Plaza Accord and then the Louvre Accord, those were like multilateral conferences. And with the type of bullying that the United States now is kind of pursuing with this, sticks and carrots policy, that's pretty different compared to the 1980s. We'll see how it's going to play out. I think that for us as investors, a weak US dollar is one of the main takeaways. I think that's pretty clear also from a technical point of view. We're now seeing some sort of a bounce short term because everybody loves to hate the US dollar. But during secular highs of the US, of the price of gold, usually the US dollar index was trading significantly lower. So, for example, now we're trading like at around 100. At the last secular high in 2011, the dollar index was trading at 75. Can we go back to those levels in the next 2 or 3 years? Absolutely. Absolutely. And I think it's also important to say that the recent weakness of the US dollar, when we are trading from 107 down to 99 something, there was mainly the strength of the euro and the strength of the Japanese yen. Compared to other currencies, especially emerging market currencies, the US dollar was still fairly stable. So we haven't seen any real dollar panic yet. But again, I think Trump wants and he needs a significantly weaker US dollar. Is he going to be able to orchestrate that without major side effects? I don't know.
I guess we will see in the next months. It certainly feels like every week there's some new playbook move from the Trump administration just to completely unsettle everybody. All right, let's talk about silver. Now, silver is what you class in your report as performance gold. Silver just seems to want to lag behind gold, though. Why has it been underperforming, even with the same macro tailwinds that gold has?
Well, I would say that, first of all, this bull market in gold is driven by central banks, and central banks don't buy physical silver and they also don't buy mining stocks. That's one of the drivers. Secondly, from a cycle point of view, gold always goes first and then silver follows. I would say that silver still kind of suffers from this kind of recessionary environment that we have, this uncertainty regarding tariffs and so on. Obviously, as an investor, but also as an entrepreneur, you don't like uncertainty. You wake up and tariffs are 50 percentage points higher and then lowered again. Then there's like a ceasefire for 90 days. This obviously isn't an environment where you want to invest like big amounts of money. So I would say, first of all, silver is suffering from this kind of recessionary environment. Silver needs reflation. Silver needs investors' demand. It hasn't kicked in yet. But I think at some point there will be investors realizing, saying, gold is already kind of expensive. It has already done well. Let's buy something that is undervalued relative to gold. And that leads us to the big long. So this outperformance that we expect from silver and mining stocks now going forward, because they are still very much contrarian plays compared to gold at the moment. And if we have a look at the structural demand drivers for silver, we're still seeing that the solar industry is doing exceptionally well. Have a look at those real projects needing huge amounts of physical silver in China, in Saudi Arabia, in Abu Dhabi. All those projects that are announced last year, there was Adani saying that they will build a solar park which is 5 times bigger than Paris. So those, it's the dimensions are just it's hard to grasp because it's just huge. I would say at a gold silver ratio almost 100, I would say silver is a bargain. Silver is a steal. I would say that with the physical deliveries that we've seen recently, it seems that there's some high net worth or hedge funds now really picking up physical silver. So silver is a pretty tiny market. So I could really see a big silver squeeze or a silver spike over the next couple of months. And I would say that if gold goes into those directions where we're expecting it to go, then we can easily see triple digits for silver, definitely.
And so what do you think would need to happen then to get silver moving, but either fundamentally or sentiment-wise?
I think it's been a big disappointment to many investors because it always feels like, okay, now it's really finally happening. Yeah. And I know so many silver bucks who are really, really excited every time it kind of wants to break out, and then it's getting smashed again. So it has to happen. We really have to see a strong move above 35, 36 again. And then I think it can go really quickly. And we are now seeing this year the fifth consecutive year of deficits in the silver market. So the physical demand is significantly higher than the supply. I would say if investors' demand really kicks in at some point, into this very, very small market, then I think we can pretty quickly go to new all-time highs. Yeah, but it hasn't happened so far. But again, not only on a relative basis compared to gold, but also in absolute terms, I think silver is very, very attractively valued at current levels.
Yeah, I mean, the sentiment around silver always seems so extreme. It's either euphoric or disinterested. And at what point do you think in the big long could you imagine that silver could have its repeat of, the 1980s, price explosion?
Yeah, well, obviously in the last phase, yeah, it's going to be really, really explosive. So in this kind of mania phase where everybody's looking for more leverage, and a little bit more momentum and more risk. So if gold goes crazy, silver goes even more crazy, obviously. And I think it could really happen over the next couple of months, actually. So at some point, I think investors will realize that there's a structural physical demand for silver driven by, especially the solar industry. They will realize that from an investor's point of view, silver is extremely undervalued compared to gold. And they will realize that it's still a very, very much of a contrarian position, because I don't know any institutional player. And I've told you before, we discussed that 1% is in precious metals in general. And obviously the majority of that is physical gold. But I don't know any bigger institution player that owns any silver. So
yeah. And so from a bullion owner's perspective, is silver a long-term value play, or is that just more of a leveraged bet on gold, would you say?
Well, we're dealing primarily with, high net worth individuals and institutional players. And for them, owning physical silver, actually, it's a storage thing. Yeah. And if you want to allocate a couple of million in physical silver, it's actually the logistics aren't that simple anymore. So I would say that when it comes to, let's say, the safe haven perspective, I would still suggest primarily physical gold and to a lesser degree physical silver. But if you regard it from this performance gold point of view, then I would say that silver is definitely more attractive at the moment.
Okay, interesting. Ronnie, you've been so generous in giving us so much of your time. I've got one final question for you. For those starting their journey into gold or silver, especially being halfway through this, golden decade, as you've called it, what's one simple principle or mindset that you'd want them to keep in mind as they get started?
One simple mindset? Whoa. Yesterday at an interview, I came up with the line that gold is a mirror. And I think that sometimes I say interesting or smart things. This just came up, and gold indeed is a mirror. It's a mirror not only of our monetary system, the economy, but also of society. So I think if you really want to understand gold, and I'm doing that for 19 years, and I would never say that I fully understand gold. Then you really have to dive into so many different aspects and so many different areas, like, again, geopolitics, then financial markets, monetary history, opportunity costs from other investments, the supply side, obviously the demand side. So it is still, after those 19 years, it's still the most fascinating thing for me and my team to think and to write about gold, to talk about our case for gold. And I think the best way to really dive into that topic is perhaps studying monetary history. And unfortunately, we are all trying to save some hard-earned money to invest properly for us, for our retirement, for our kids, whatever. but nobody actually teaches money. What is money? Where is it coming from? Why do we have inflation? And therefore, I think this should really be the starting point. And I know that there's lots of arguing and fighting between the Bitcoin camp and the gold camp. We like both. We've got one fund for 5 years now that combines physical gold and Bitcoin in cold storage. It works extremely well. And what I really like about Bitcoin is the fact that so many young people now start to question our monetary system. They learn about monetary history. And sometimes they also end up in the gold camp. Yeah. So I think that should really be the starting point, trying to understand money. And there's, you don't have to go to the library anymore. Just go on YouTube. There's like great tutorials. So it's pretty easy to learn about that. And I think then if you understand sound money, if you basically took the red pill, then it's going to change your perspective on everything. Yeah, not just on money and investing, but also when it comes to time preference and many other things.
Ronnie, this has been such a fantastic conversation with so many wonderful insights into your report. Where can our viewers go to enjoy a copy of the In Gold We Trust report and learn more about your fund management services?
Well, just have a look at ingoldwetrust.report. Perhaps we can also show it in the show notes of this conversation. You don't have to register. You don't have to pay for anything. Just download the report. I know that not everybody is keen on reading 450 pages about gold, so there's also a compact version. There's a video that summarizes the key takeaways. We've got a slide deck with the best charts. We're pretty active on Twitter and on LinkedIn. You can download all previous 18 editions of the In Gold We Trust report. We do monthly chart books. We publish in several languages. The Chinese report will be published in November again. So yeah, just have a look at ingoldwetrust.report. And for our asset management, that's incrementum.li. We offer 7 investment funds and wealth management for high net worth individuals.
Fantastic. Thank you for sharing your time today and thoughts, and thank you to you and your team for your incredibly thorough research and making your invaluable report freely available to everyone.
Thank you very much. It's been a great pleasure. All the best.
Thank you to our audience also for joining us. I'm Claudia Merkert from BullionStar, and I look forward to seeing you next time.